Your chart of accounts isn't just numbers, it's the story of your business.
Let's build a COA that speaks with clarity and purpose.
A COA that tells a story doesn't just classify transactions, it connects decisions.
The chart of accounts, or COA, is the financial DNA of every organization. If designed poorly, it becomes a long, confusing list of numbers with no meaning. If designed well, it becomes a narrative system, showing what happened, where, and why. A structured COA transforms simple journal entries into strategic intelligence. Instead of only seeing totals, executives see context, cost by product, revenue by region, and project performance by function. When your COA speaks, finance data turns from static into story, and that story drives insight. This graph shows that when you attach structure, like company, function, and product, each line in your COA tells a complete financial sentence.
In digital finance, your COA is not a list, it's an engine that powers insight.
A modern chart of accounts must go beyond bookkeeping. It's not just about tracking, it's about translating finance into strategy. There are 4 objectives every COA should fulfill. Structure: align your codes with how the business actually operates, not outdated legacy formats. This makes reporting and consolidation faster, cleaner, and more intuitive. Scalability: your COA should grow with you. Whether it's new entities, products, or platforms, the data foundation must be ready to expand. Traceability: every transaction should link to its source and outcome. That's how you simplify audits and unlock analytics. Meaning, use terms your business leaders understand. Because faster decisions come from clearer language. When these 4 objectives align, your COA transforms from static storage into a dynamic insight framework, ready for growth, ready for leadership. Here, each objective builds on the next, from order to growth, from data trace to meaning. When all 4 align, your COA becomes future-ready.
Every COA entry should read like a sentence, not a random code.
A good chart of accounts is layered, like chapters in a book. Each segment adds context, turning raw data into readable logic. Start with the company code, that's your legal entity. Then add function, like sales or operations. Cost center points to the department. Account defines the revenue or expense type. Project links the entry to a specific initiative. Product shows what's being sold or supported. And geography tells you where it happened. Put it all together and you get a full sentence. Sales expense for product SW01 in Thailand under project P003 of company 1010. This is how financial entries become narrative data, clear, traceable, and strategic. Each layer builds context. When read together, they create a sentence that describes the business, not just the transaction.
A smart COA isn't born from accounting rules, it's built from business logic.
Here are 5 design principles that make your COA truly insightful. Start with the goal, not the code. Define what you want to measure before assigning numbers. Point 1 meaning per code. Never reuse codes for different purposes. It destroys consistency. Flat when possible, deep when necessary. Keep simple hierarchies for automation, but detailed enough for strategy. Use business-friendly names. Replace cryptic terms with real-world labels. Assign ownership. Each segment should have a data custodian to ensure accuracy. These principles make your COA readable by both humans and machines, a key step toward automation readiness. The chart shows how each design rule contributes to both governance and intelligence. Clarity at the code level equals control at the decision level.
Your ERP is only as smart as the COA it runs on.
No matter how advanced your tools, ERP, BI, FPandA, or RPA, none will produce clarity if your COA is chaotic. A poor COA equals messy data, poor dashboards, and inaccurate automation. A structured COA equals fast consolidation, clear dashboards, and confident decisions. Remember this golden rule. Automation doesn't fix bad data. It multiplies it. That's why digital finance transformation always begins with a COA quality review, mapping, cleaning, and redefining. This pyramid makes it clear, every system stands on one foundation, the chart of accounts. If the base cracks, everything above it shakes.
When COA structure meets analytics, insight becomes automatic.
A COA designed around business drivers unlocks insight instantly. Examples. COGS grouped by product line equals margin analysis by product OPX aligned with strategy pillar equals budget versus strategic outcome revenue split by channel equals distribution performance tracking. When data follows logic, systems like Power BI or Tableau can visualize instantly, no manual grouping needed. This flow illustrates how clean COA data travels through analytics pipelines. The cleaner the input, the clearer the insight.
Your COA isn't a document. It's a living financial asset.
A sustainable COA evolves with the business. Regular reviews prevent data decay. Remove obsolete codes, merge duplicates, align with IFRS, GAAP, and local tax codes. Assign governance roles, finance for accounts, HR for cost centers, projects for initiatives. Each custodian ensures updates remain controlled and consistent. This life cycle view reminds us governance isn't an annual cleanup. It's a continuous process that preserves data quality.
Good accounting classifies. Great accounting communicates.
A well-designed COA links operations, finance, and strategy. It helps leaders see connections, not just numbers, and act faster with confidence. When your COA speaks the same language as your business, reports stop being history and start becoming foresight. The final image symbolizes how structured data bridges the gap between accounting and leadership insight.
If this helped you see your COA a story of strategy and insight, subscribe and join me, Thanya.
For more finance transformations made simple.